only thing that can stem the sell-off in the bond market is for equities to crash. That's according to Barclays. Now, analysts writing in a note that there is no level for yields to reach that will automatically draw buyers in for a bond rally, saying, quote, in the short term, we can think of one scenario where bonds rally materially, and that is if risk assets fall sharply in the coming weeks. For more insight on this, we want to bring in Yahoo Finance reporter Josh Schaefer. And Josh, your biggest takeaways from this note?
Yeah, Sean, I mean, really what you were just referencing there is a little bit of what we call a flight to safety, right? So you would see investors move to bonds out of those risk assets, and there's a couple things that can cause that. You mentioned maybe a market sell-off could cause that, or even just stocks moving lower. There are plenty of calls out there right now still to just see the S&P 500, at least in the short term, move a little bit lower, maybe even below that 4,200 level, again, in the near term. That could push people to bonds. The other thing you're looking at on your screen right now, weaker economic data. We know if we were going into a recession, bonds would normally become more of a popular play. And we saw even yesterday, very, very small sample size, but we saw weak jobs data, weak labor data, and we did see yields come down a little bit. So that will be something to watch when we look forward to tomorrow and that jobs report. What does weak data do to yields? Does weak data actually bring down that yield, which could in long term eventually help stocks? But then also we're talking about a slowing economy, which isn't necessarily great for stocks either in the long run. So I think the biggest takeaway that Barclays had here was there isn't a lot good to look at when we think about how high yields are right now, at least in the short term. That seems to be the broadest takeaway here, is no one really has a great answer for when we're going to see those yields come down significantly.
All right, Josh, thanks so much for the analysis, helping us break that down this morning.